Let's start this explainer off with a quick confession. If you've been feeling a massive case of FOMO over the last few days, you are absolutely not alone. Look, the recent market shifts have literally forced analysts everywhere to take a hard look at standard portfolio strategies. And hey, if you've been completely ignoring dividend stocks for the last 2 years, well, it kind of made sense, right? Growth and AI, that's been the only story in town. But over the last month, something massive just shifted right under our feet. So let's dive into this, because what just happened in the market is honestly nothing short of historic.
Check out this headline that was flashing everywhere just a few days ago. We told you to forget SCHD. It just beat the S&P by 12 points, its biggest win ever. I gotta tell you, when I first read that, my jaw practically hit the floor. It completely shatters the narrative we've been fed for the last 24 months. If you're sitting there feeling a little shocked, your reaction is totally valid. And that is exactly what we're gonna demystify today. Are we looking at a crazy one-off event, or is this the start of a massive new trend?
I really want to emphasize this number, 12. SCHD didn't just edge out the broader market, it absolutely crushed the S&P 500 by 12 full percentage points in just the last 30 days. To put that into perspective, outperforming the S&P by even 1 or 2 points in a single month, that's a huge achievement. 12 points is a landslide. It's the central mystery of our explainer today, and to figure out how we got here, we really need to rewind to look at the facts.
Section 1. What actually happened?
So there's a pretty stark contrast in what these two funds actually hold. First up, we have SCHD, the Schwab US Dividend Equity ETF. Now, this isn't some flashy new fund. It's basically a basket of about 100 US dividend-paying stocks. We're talking high-quality names, but frankly, they're boring businesses with super reliable cash flow. Think Johnson & Johnson, Pfizer, Coca-Cola. On the flip side, you have the S&P 500. Over the last 2 years, it's been driven almost entirely by the tech sector and the Magnificent Seven. For all of 2023 and 2024, boring lost and tech won. SCHD lagged badly, trickling up in the single digits, while the S&P just ripped upward by 20% plus. That is, until 30 days ago. The tables completely turned, and SCHD had its largest margin of victory ever. Which, of course, brings us to the most important question.
Section 2. Why boring suddenly won?
Let's break down the macroeconomic mechanics behind this sudden rotation. It really boils down to 3 core reasons. Number 1 is interest rates. The 10-year Treasury yield recently dropped below 4%. It's a pretty simple rule of finance. When yields fall, dividend stocks suddenly become way more attractive compared to bonds. Number 2 is earnings rotation. Investors basically started pulling their cash out of highly valued tech stocks and rotating it right into cheaper defensive sectors like healthcare, financials, and consumer staples. And guess what? That is SCHD's exact playground. And number 3, valuation. Investors are actively seeking safe havens right now.
Just look at this stark valuation gap. Right now, SCHD is trading at roughly 15 times earnings. The S&P 500? It's sitting way up there at 22 times earnings. When the market gets a little nervous, people naturally look for a place to park their cash where they aren't paying some massive premium. Those cheaper, value-oriented stocks in SCHD start to look like an incredibly comforting safe haven. So yeah, SCHD undoubtedly won the battle this month. But what about the overall war? For long-term investors, we need to be objective and look at both sides of the battlefield.
Section 3. The bull versus bear case. The bull case for SCHD going forward is pretty strong. You're getting a 3.5% plus yield, and these companies have a serious track record of raising their dividends every single year. It's still historically cheap compared to growth. And defensively, well, in a recession or a market correction, SCHD historically falls about half as much as the S&P 500. It acts like a shield. But we have to weigh that against the bear case. SCHD definitely has a growth ceiling. Over a 10-year period, it's historically compounded at around 9% annually, whereas the S&P 500 has done 11 to 12%. That 2 to 3% gap, it adds up enormously over the decades. You also have tech rebound risk. If the AI hype resumes its massive climb and rates drop even further, growth stocks could easily leave value in the dust all over again. Finally, SCHD is heavily concentrated in financials and healthcare. If those specific sectors stumble, you don't have the rocket fuel of the tech sector to bail your portfolio out. Both sides make really valid points here. And it all depends on your timeline and your risk tolerance, which brings us from theory straight into practice. You aren't just here to look at headlines, you want to know what this means for your actual strategy.
Section 4. Your action plan and what to do right now. We can actually break this down into 3 specific buckets based on where you are in your investing journey. Bucket 1 is for retirees, or folks who are under 5 years out. The consensus here is to really focus on protection. Analysts suggest using this rally to rebalance toward SCHD if you've been underweight. Look, at this stage, the data shows you don't necessarily need to beat the market. You need to protect what you've already built. A 50-50 split between SCHD and a bond fund is widely considered a pretty prudent idea right now. Because let's be real, being able to sleep well at night often matters infinitely more than squeezing out an extra 2% in gains.
Moving on to bucket 2. This is for growth investors, typically in your 30s or 40s. The primary warning from the data here is simple. Do not chase this rally. SCHD is not a primary engine for wealth creation. Instead, sources suggest using it as a shock absorber. A really common strategy is to allocate 10 to 15% of your portfolio to SCHD as a hedge. When tech inevitably corrects, SCHD cushions the blow. But when tech rips higher again, you're still primarily participating in that upside. For this bucket, it's all about diversification, not replacement.
Finally, we have bucket 3 for the active traders out there. Tactical strategies suggest watching the 10-year Treasury yield like a hawk. If it stays below that 4% mark, value stocks could absolutely keep running. But if it spikes above 4.5%, analysts expect SCHD to give back some of these recent gains. For short-term plays, setting a stop loss at 5% below current levels is frequently cited as a highly tactical way to manage your downside risk. But regardless of which bucket you fall into, a 12-point win doesn't necessarily mean we're in some permanent new era. Just look at the 10-year chart. It's basically the tortoise and the hare. SCHD is the tortoise, and the S&P 500 is the hare. The hare is going to win most of the races, but the tortoise, it finishes every single one. It is reliable and defensive by its very nature. So how do we look past the daily noise? Simple. We zoom out.
Section 5, the 2035 perspective. Let's walk through the cold, hard math of a 10-year horizon. If you put a $10,000 investment into SCHD today, based on a historical 7 to 8% average return, you'd project out to roughly $20,000 to $22,000 in a decade. But if you put that same 10 grand into the S&P 500 at a 9 to 10% return, you're looking at about $24,000 to $26,000 by 2035. So mathematically, you are giving up roughly $4,000 in potential gains over a 10-year period. But in exchange for that, you are cutting your portfolio's volatility almost in half. For some investors, giving up $4,000 is a terrible trade. But for others, cutting stress and volatility in half is literally the best deal on the market.
Which brings us to the ultimate bottom line of today's explainer. The data strongly suggest building your portfolios for decades, not days. Please don't let one dramatic headline fundamentally change a solid, long-term strategy. SCHD just had its massive moment in the sun, and frankly, based on the fundamentals, it fully deserved it. But the general consensus? Chasing headlines and selling your tech to buy SCHD at the absolute peak of a value rally is a guaranteed recipe for buying high and selling low. And that is the exact opposite of how wealth is actually built.
So where do you stand on all this? Are you team SCHD, team S&P, or have you found a clever way to be both? Will you let a month of historic data alter your decade-long strategy? Let me know your plan down in the comments because I read every single one. Thank you so much for joining me to break this all down today, and I cannot wait to see you in the next explainer.